All right, welcome back to the R&D Room Live. We are here to learn more about options trading in a small account. We went through the 3 videos yesterday, the last live stream. And if you want to go back and check that, it is on my live stream tab on my YouTube channel. So we went through the beginning, part 1, 2, and 3. And our goal is to go through all of the TastyBites that are available to date. And it's going to be a learning process. It's going to be a journey to learn and to be successful in trading options, no matter what your account size is. I'm trading with $12,500 right now, and I'm following these steps as we go along. So let's look at the objectives, the homework that we needed to do yesterday, just from the videos that we watched. We needed to create a watch list of stock ETFs and inverse ETFs, and they need to be liquid. Well, it's interesting because on TastyTrade, let me put on private. So I made a watch list. I made 2 different watch lists. It's market awareness and TastyBites. So whenever you're making a watch list, they said many times yesterday, you're looking for liquid ETFs. And lo and behold, TastyTrade has on the watch list liquidity tab, and it has liquid ETFs. And I just put everything on here. I think except for, I think I might have taken XOP off. I'm not sure. But I just pretty much copied this watch list and it started adding individual stocks to it as I was searching through and finding different stocks. So I'll probably, what I've got is a way that you can sign up for a newsletter, which I don't really send anything through the newsletter, but it gives you a way that you can download a file that lets you import a watch list, my watch list, through a link, and then you can import that into your TastyTrade. So, if you already know how to do that, you know what I'm talking about. I may make that available and then put the link down below. But really what I want to show you is that's the standard there. I added, as I was looking this morning, all the way from XOP, looks like I left XOP on there, but all the way from XOP down are stocks that I added, and I may add more. I think I've got close to around 40, and that's about what Tom said to do, was have about 30 to 40 stocks picked out and, go from there. It's a good start. The other thing that I know, and just from watching the videos already, market awareness. So they talk about that a lot in learning what, looking at, and they use futures here, but looking at these tickers and finding out what the market is doing in general. And they use futures because they are open more often and more available, so you can view and see how the market is doing even whenever it's technically not open. So it gives you an idea of what's happening even when the market's closed. And like I said, I just got that from an existing one. I think it's under, let's take a look. It just says market down here. So pretty much what I did was I just copied the market one and just made it my own and called it market awareness. And if I need to add a ticker to that, or if I think there's a group of stocks that are moving, the S&P 500 or something like that, then I may add it to the market tab. But that's how I'm going to get an idea of how the market's doing. Keeping an eye on this and looking at the watch lists. That's something that Tom mentioned as well. Not being so mindful on your P&L, but watching the market and seeing what that's doing so you can make a decision on that. So I wanted to share that with you. That's an update of what I've learned. I've learned a lot about volatility as well. So I've adjusted my watch lists and my columns here to have IV. You've got IVR. That's over the course of a year, what the rating is on a percentage basis over a year. You have IVX, and that's the percentage of volatility, of implied volatility that it has. And then you have the IVP, which has 2% here. That gives you basically a gauge of where is it at on a percentile basis on its implied volatility. So if it has a high IV percentage, IVP percentage, it's basically like we're seeing 91 on Hood. It doesn't trade at this implied volatility very often. So that's a big clue there that says, hey, there's high implied volatility here, and it's out of the ordinary over the course of a year, I believe. So really interesting stuff, and I wanted to change that. Of course, we need liquidity. That was brought up many times. So that was one big thing of, it actually took me most of my time getting that done. Finding 3 to 4 strategies. I'm doing a put call spread, credit spread there. Iron condors, I want to get more involved in that. And even maybe strangles on some small dollar stocks. That's something that they bring up as well on TastyBites. I'm already doing the wheel strategy, but I may be adding the Jade Lizard when it comes available. And we'll see that in other videos, but I've already got that in mind from watching the other videos in the future. So I will be trying that out in my account. I've heard butterfly a lot of times, that strategy, iron butterfly. So potentially that. And then I'm trying out the 0 days to expiration iron condor, which that's kind of looped in with the iron condor as well. So, I wouldn't really call that it is a strategy on its own, but it's very small and we're just doing a proof of concept on that. I'm doing that 3 times a week. So already doing the wheel. Strangles and iron condors are related. Put and call. So that's 3 or 4, potentially 5. Looking at my allocation. Let's see. I'm getting ahead of myself. The buying power reduction number, my BPR number per trade, especially for defined risk, is $100 to $150 per trade. I want to be able to increase my number of occurrences as much as I can. So trading small there allows me to place those trades and get those occurrences in. Let's see. Minimum number of trades. I was thinking 12 because I have 3 positions on the wheel. So if I do 3 trades on the wheel strategy, I'm doing 0 days to expiration 3 times a week because I'm under the PDT rule. That's going to be 6. And then if I do any of these other strategies, we could potentially be seeing another 6, whether it's closing positions or opening positions. So I'm just thinking probably 12 a week. Let's see. And then my allocation, I'm not exactly sure of my theta decay yet. That wasn't a number that I could quickly come up with. But 1% per trade, and that's based on the BPR. So I've got to get that calculated in my head before I open an order. So I'll let you know about that, kind of what I see about that. And then setting reasonable expectations. We're not hitting home runs here. We're trading small and often. Small returns, consistent returns, and getting our head on the mindset that we are collecting a little bit with a high probability of success. And then portfolio allocation. I estimated I've got around $2,500. It's difficult to do this with a margin account, but I just know that I've got any frigged up cash that I have because I'm on margin is in T-flow, so I discounted that. But I did not discount the wheel strategy. I did that. If I'm doing a $2,000, or if I'm doing a $20 stock, that's 100 shares of a $20 stock. That's $2,000 of cash. If I was to get exercised on that option, so I went ahead and counted that as if I was expired in the money and I had to own those shares. So there's a lot of capital allocation, cash wise, not margin wise, but cash speaking, that's in the wheel strategy should they get in the money and I let them expire. So I do have a lot of capital in that. And then I've got 650 in R&D spreads. That's the credit spreads that I was talking about. That's 5%. And then R&D, research and development, I'm going to do the iron condor. That includes my 0 days to expiration, 5% as well. So there's the 10% for my R&D, doing the iron condor and the spreads. I'm locked in on the wheel strategy. I feel very confident about that. That's not something that I'm testing out. The only thing I'd be testing out there is the Jade Lizard. And then the stock, that's Tesla, which again, I talked about yesterday, potentially moving that into a different account. So it doesn't, it's not really allocated to options trading. So definitely want to own Tesla. There's no doubt about that. There's other stocks that I want to own, but that's kind of a different account. I've ut different goals for that kind of trading and investing. So it's not options, but nonetheless, it is part of my account here, and it needs to be put in there. So that's just kind of a rough estimate there. It's nothing fancy, but after watching those 3 videos, this is what it looks like, kind of after looking at what needs to be done to get your account set up. Maybe your account is 5,000, maybe it's 20,000, maybe it's 50,000. I don't know, but this is just kind of how I played it out and the different strategies that I plan on doing and trying out to try out with the currencies. So that's what I've got out of these 3 videos. Let's not waste any time here. Let's get into, we're going to try to get 3 videos in today. So let's give that a try. This one just says TastyBites. It's the 4th one of the series.
Because I switched to my iced tea. I know it sounds crazy. Okay.
Okay, well, I said I cut my nails this weekend, and I said that
I went back to the champagne of teas.
Oh, because, you went to the good stuff.
Yeah, well, so I'm a little worried here.
So we've come full circle. I remember trading on the floor. You would say that you'd go out and buy a big ticket item, kind of change your luck, do something different, get you hungry again.
I don't do the big ticket items anymore.
You don't. Well, I said when you were on the floor. Yeah. Listen to what I say. It's all you have to do is just listen to what I say.
Right,
not what I'm thinking. Because if you listen to what I'm thinking, it's a very scary place to you. Okay, right now. So all I'm saying, just listen to what I'm saying. Unlike
I never want to see or hear what you're thinking because I already know that I'll never be able to.
You would buy a big ticket item on the floor, get you hungry again, get your game on, get you focused, get you concentrate. Now you're changing or a dog.
Or a dog.
Changing your
when I was on a really bad streak, I'd either buy a dog or a big ticket item, and that would try to change my luck. Now I'm just switching up iced tea.
I'd go to Okasaka in Indiana.
Okasaka. I don't even want to know. Nobody wants to know. Right now they're Googling Okasaka, and they're coming up with something really scary. All right. S&P's down 325. The Russell futures down 3, and bonds are still down 12. And I told you, I've had a bond.
And also for those of you watching, I did add the chat to the screen. So if you have any comments or any questions like that, you can pop them on there, and then they can be. It's more interactive, I think, if you can type and see what's going on. And as you have a question, then I can answer it, or we can try to find out together. So, or if you want to share something, everybody can see it.
Bond swap on for a year. Remember when I did it a year ago?
I do remember.
It
was the trade of the century.
Trade of the century. I've done 4 bond swaps outside of normal trading.
I remember them bringing the
over the counter
cardboard box full of disclosures that you had to fill out to
I just decided
make the trade.
I don't want to fill out the disclosures, so I'm just going to close the bunch. I've done it 4 times. Each time I've taken 4 times the risk of the potential profit, and each time I've just kind of held in there until there's a small profit. But I just took that one off. That's the only position I'm closing. All right, you ready?
I am, sir.
TastyBites.
Dun, 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 dun.
Hang on 1 second. Okay, so here's what I did. I put on the column A, which is I'm sorry, on the letter A. This is what I talked about last week. On number 1, it's defining it this week as we're going to start getting into putting together the first steps of making the first trades. And I'm hoping that we have time today to at least get into the discussion of the first few trades. All right. So TastyBites, again, is for people that have smaller accounts. Now, the minimum account size I would say for this is about $2,500. And it's something along the lines of what I'm doing, like with Case in the afternoon of where do I start? And it goes as high as $20,000. Doesn't really matter to me. I decided to use a base starting amount of $5,000. And the reason I did that is because I wanted to create a separate account that I can track, because I usually trade an account that's bigger than $5,000. So what I want to do is...
Oh, yeah, because Johnny, you're a big shot.
No, that's not what I said.
You, yeah. Oh, yeah. No, not you. 5,000.
Stop, monkey. I created a whole new account so that I could trade a $5,000 account, so that I could trade along with this TastyBites. So over the course of the next year, every time we do a TastyBites segment, we can kind of see how we're progressing and see how we're doing, because it is difficult to trade small accounts. There is a linear relationship between the amount of capital you have and the probability of success. And the probability of success, because the probability of success a lot of times depends on your ability to do things that require more capital. There's 2 limitations to this business. One is capital, and one is account type. Now, since TastyBites, account type, like limited margin IRA accounts, things like that, IRA accounts have limited upside or more difficult upside because of the strategic limitations placed on that account. The product limitations, strategic limitations. Smaller accounts have a similar issue. They don't have the strategic limitations the same way, but they don't have the margin limitations, but they do have the strategic limitations. So I figured, you know what? Let's prove that. Let's prove concept. And so I created an account with a starting balance of $5,000, which is, again, the objective here is to commit 20% of the allocated capital. So let's go to the next one. So to commit to 5 trades, first off, so I've decided we'll do a covered call or a covered put, a credit spread, a debit spread, a naked short put, and a calendar or diagonal spread. Those will be the 5 spread types that we commit to right out of the chute. Again, a covered call or a covered put, a credit spread, a debit spread, a naked short put, and then either a calendar or a diagonal spread. So we're going to go both horizontal and we're going to go vertical on this. Okay, and we're going to commit to 5 trades, and we're going to start with $5,000, and we're going to use 20% of that $5,000 to start with, which is $1,000. And if I commit that to 5 trades, it's about $200 a trade. Let's go to the next slide. And all this will be in the archives. So what we're doing is we're saying we're committing about 4% to each trade, which should average around $200 a trade. When I say average, because you might want to do one trade that's like $50 and one trade that's like $350. That's fine too.
Sure.
I don't care because
just a guide.
That's right. It's just a guideline. It doesn't have to mean each trade has to be $200. It just means in the end of the 5 trades, I got to get somewhere close to that. There's nothing. But
if you saw a trade in there for $1,000 worth of buying power, you might say, you know what, that's something that's outside of my little parameters.
Exactly. Because I want to get 5 trades out of $1,000. But I also want to focus in the end of getting enough occurrences. So I'm looking at 4% per trade. And again, to put this in perspective, it's a $5,000 account. There's 5 different strategies. There's a covered put or call. There's a credit spread. There's a debit spread. There's a short put, and then there's something horizontal, whether that's a calendar or whether that's a diagonal spread.
Very good, sir.
Okay. D. Okay, I want to create an average of 1% of positive decay per trade based on buying power reduction. So the next piece here is that means I need to deliver approximately 5 on my first tranche of investments. I need to deliver about $5 a day in decay, and that's when opening all 5 trades in total. So now I'm starting to get, with a certain number of days to go to expiration, in this case, it's almost 43 or 44 days to go to expiration, I'm focusing on $5 a day. $5 a day, that's in premium decay. That number is going to accelerate as we get closer down the road to expiration. And that $5 a day, which is about 0.5% a day, in the end is going to come out to about 1% of positive decay. The reason I'm putting this up here is because you need to understand that over time, that number increases. And over time, even though you're starting at about 0.5% of positive decay per trade, you're going to end up with about 1% as we get closer to expiration. Okay, and that's on all 5 trades. We're going to look at single point strikes, minimal number of strategies, and low delta plays. So the takeaway from this is that my max SPY weighted delta is about -15, and my target weighted delta is -7.5 in total. Now, if this stuff all seems a little bit new or French to you, or whatever you want to say, it's because very few people have presented small accounts with this kind of generalized criteria. I get so many emails with respect to, hey, put some definition around this, that I decided, okay, I'm going to put some definition around this.
Okay, well, I love that you're doing that, and I think this is fantastic. Those are some pretty tight parameters.
I know.
I mean, you're talking about a delta of -15. You're talking about on directional risk.
SPY weighted delta.
SPY weighted deltas. That's what I think delta is, my risk in direction
Correct.
of 15 shares of stock. That's what -15 means. With a target of 7.5
on the first $1,000. That means on your total $5,000, your SPY weighted delta, okay, on your total SPY weighted delta is going to be on the perfect target would be between 30 and 40 SPY weighted deltas, with 37.5 being perfect, and the max delta at that point will be -75. SPY weighted deltas on $5,000. Because I think on a $5,000 account, if you're talking about 75 SPY deltas, I think everybody can handle that. That's a max. And if you're talking about half that much, which is 37.5, or between 30 and 40, I think that's a reasonable target. And again, notice how I put negative in front of this, because I don't want anybody to think that we're always negative delta, regardless of market conditions, because we're short premium.
I know. Gotcha.
Everybody asks for definition. I'm giving you definition. Okay. I'm not saying it's not the you don't do this and you die type thing. It's just that, hey, you want definition? I'm going to give it to you. This is all for the first 20% of the portfolio, the first 5 trades. These are total numbers. Let's go.
So he was given a lot of he was being very specific there, but actually the SPY weighted delta would look positive, I believe, on our account in TastyTrade. So I was looking at that. Why would we have a negative delta? What he's talking about is the delta right here, this 36 on my account. He would target 15. I'm not sure about 7.5 in total. It's half of 15, but I'm not sure if he was doing it wouldn't be per trade, so I'm not exactly sure. But I'm At least on mine, I'm well over. And I've got, stocks that I buy that I think affects the delta a little bit, but pretty well not. I'm pretty light on the delta when it comes to my spreads, credit spreads, and things like that.
To F. So define max profitability and reasonable expectations. Okay, so approximately $350 is your max profitability, and your probability of profit is about 66%. Again, remember, we can't take this out of context. This is all based on committing $1,000 of capital. So now, is $350 or 35% for 45 days? Isn't that a ridiculously optimistic number? The answer is, of course, it is. Read the top line, which says define max profitability.
Correct.
Yeah, I see what DT says there, and that makes sense. Because if you own the shares, you're going to be long. And selling calls, it's a bullish strategy. So I guess you would have that positive delta, if I'm not mistaken.
Okay, you're going to have months, you're going to have cycles, because there's 8 cycles embedded in these numbers where you lose money, all right? But if the question is to find max profitability and set reasonable expectations, a reasonable expectation for the current implied vol marketplace is somewhere in the mid-60s, and a reasonable expectation of profit from that is the inverse, okay, which says it's about $350. Does that mean that's an easy number to get to? Of course it's not. In fact, if it was, everybody in the world would do this every day.
Of course.
In the end, what are you really looking for on that $1,000, on that one piece of the thing, on each commitment that you make? Maybe you're looking for just a extremely low percentage of that, because in the end of the year, you're looking to make a good return, maybe a good return on 8 of these cycles, maybe $350 for 36% or 35% annualized return,
correct,
which means that you've got to, in the end, 8 of this divided by, you're talking about maybe $40 or $50 works, but you have to set max profitability so you know what you're capable of making, so you can put everything in perspective, and then you put probability of profit out there so that you can have reasonable expectations of how you should be doing. Okay?
Nicely done.
All right, let's go to the next one. So next, a minimum of 3 to 4 weeks to duration. Right now, since we're going to be doing March, we have 44 days to expiration. So is that what it says? 43 or 44?
I think it's 43.
43. Okay, so it's perfect.
44. You got it.
Okay, so it's perfect. So right now, because of the timing, we're mostly March, and now it's with 44 days to go to expiration, to DTE's days to expiration. And is there one more? Stay in liquid underlyings. So we're looking for single point strike ETFs and leverage ETFs. I am going to do no individual stocks out of the chute. Okay, it's all going to be single point strike ETFs and leverage ETFs.
That in itself is a hard thing to do.
Well, in a market, in an environment like we're in right now, the answer is yes, it is. Okay. But it will allow us to trade lots of different things. Okay, it will allow us to do things like I don't have to only do, like with Case, her first trade is going to be short put. I have to find a very inexpensive stock so that I don't use too much of her capital.
Right.
By doing this for TastyBites, these are for people may be much more experienced. They just don't have the capital. If you don't have the capital, you have to learn how to build capital. It's a process. And because you don't have access to the highest probability trades, you lower your expectation from whatever it is, 72, 75 down to 62, 65, somewhere in that range. And you allow yourself, though, to trade any underlying that has single point strikes. Okay?
Very good, sir.
Let's go to the next one. Okay, so give trade examples. So, and I didn't want to list all these, Tony, because I started going through them last night, and I realized, you know what? We have to put up a screen.
I got you.
Okay, so Linda, I want to go through these one more time, then I'm going to give a couple trade examples. I'm going to save about 5 minutes for trade examples, and I'm going to try to execute at least 1 or 2 today in my new TastyBites account. So let's go through them again, starting with the first one. I'll go through them really quick. Commit 20% of the allocated capital. The base starting capital here is $5,000. So the commitment is I'm determined to commit $1,000. Okay. Second one, I'm committing to 5 trades. That's an average of $200 per trade or 4% per trade. I'm also committing to 5 different strategies up front, so I don't run into a level of confusion or just apprehension or just, nervousness, whatever it is. You know what? I'm committed to these 5 trades. I'm committed to using $1,000. I'm committed to 5 different strategies because I need to see what works best for me. Covered call or covered put, credit spread, debit spread, naked short put, calendar, or diagonal. Okay, and these are fully margined accounts. These are not cash accounts. These are fully margined. 4% per trade should average $200 per trade. Keep going. Create 1% of positive decay. I know I'm going to get emails on this, so I have to just
I've already got 100 of them because it should be $50. They're saying 1% a day, that kind of thing.
No, I'll explain. Let me get into all the details later. But it should, in the end, it needs to deliver about $5 a day. Okay, which is when opening 5 trades in total.
Mm-hmm.
$5 a day, not $50 a day, not $500 a day, $5 a day, and that's on full $1,000. Keep going. Single point strikes, max buy weighted delta of -15, target delta of -7.5 in total, and that's all weighted. max profitability about $350, probability of profit somewhere around 66%. Those are reasonable. Yet the max profit, I just want to throw that number out there just so you can put some perspective around it. And again, let's just do the last two and then move on. 44 days to expiration. That's March right now. Keeping everything consistent, and the single point strike ETFs and leveraged ETFs, that is very important to this methodology here, because I do not want to focus on anything about individual stocks. I have no problem focusing on cyclical rotation, on different types of sectors. I have no problem focusing on contrarian plays. It doesn't matter to me whatever your assumption is. It makes no difference.
Gotcha.
Just understand the risk of your assumption, that's all. And as long as you stay within the delta numbers, I don't care.
I gotcha.
All right, let's give some trade examples. Tony, let's go to the TOS platform for a sec.
Sure.
One of the areas of interest for me is because I've been trading a lot of things like, I'm interested in things like the euro. I'm interested in things that are happening around the world. I also want to mix up the portfolio a little bit. Let's take a look just on the surface at things like, for example, we've been interested in looking at the Chinese market.
Yes.
So let's go to FXI for a second. Now, one of the things that we're focusing on here is we want to put ourselves in a position where we talked about all the different types of spreads we want to do. FXI's had a huge move to the upside. I'm not going to say everything's had a huge move to the upside, so it's not really kind of fair to say that it's
true. It's not an outlier.
It's not an outlier. It's just had a nice move to the upside, and I want to start to create. Okay, up at the levels we're at right now, I want to start to create just different types of spreads. All right. So first,
correct, but you're going to keep your SPY beta weighted delta to 75 or under for the whole account.
For the whole account, I'm going to keep it on these 5 trades to 750. Okay, 7.5 shares of SPY in the end. So what I'm going to do is I'm going to start to focus right out of the chute on just putting some positions on, and I'm going to do this fairly quickly.
Gotcha.
Okay, so let's open up March options,
because those are the ones with 44 days.
Now this is low implied volatility here, and in low implied volatility with half point strikes and tons of open interest, which is why I selected this one. Okay, and you can see we're at the ridiculous low end of the of vol percentages. We're going to go to March options. We're going to open them up, and this gives us an opportunity here to, if we had to tweak the amount of dollars we're committing, okay, we could do that. I'm going to go
$half wide strikes are interesting for you in this instance.
Correct. I am going to go half a point in the money to the 42 puts. I'm going to right click. I'm going to move my cursor to buy. I'm going to move my cursor over to vertical. I'm going to left click on vertical. And the first trade is going to be doing the 42.41 put spread.
It's about 49 cents.
And I'm going to do it 2 times to use about I'm going to use about $100 in capital. Where's my pen?
I got it for you.
I know. I just don't want to put the orders in as we're speaking right now. And so I'm doing the 41.42 in FXI, and I'm doing it 2 times. And it's going to be about 49 or 50 cents, wherever it is. I'm going to put a 50-cent cap in, but I want to see when the market opens this morning. Okay, and that's going to tie up $100 in capital, and that's going to be my first put spread.
It's basically unchanged this morning so far.
Yeah, and just so we're clear, the stock is it's no premium one way or the other. Now, my focus is getting to 66%.
You're not selling any premium, so you're not getting that theta decay number that you were looking for.
There will be a very small amount of theta decay in here.
Gotcha.
Okay, but the problem with it is 50-50 probability of success. So now I've got to go to my next trade where I have a higher probability of success. So the next thing you're going to pop in is EEM. Okay, now in EEM, again,
So I think it would be really cool if they actually carried through, their $5,000 account all the way through the TastyBites and see where it is. They actually, I don't know why. I'm sure there's some reason why they stopped doing it, but it's interesting to see how they play through it, as we go along. But just to keep you in the loop and not to give your hopes up, they don't actually go through every single trade through the TastyBites. It turns into more of a study-based discussion and kind of direction of how you would do it based on the studies.
I'm picking highly liquid stocks to start with. All right, we're going to open up March options.
Also another low volatility stock.
It is a very low volatility play, but I'm also going to be looking for some directional stuff up here because I'm a contrarian. I'm staying very small, very short. I'm staying very small, close to the vest, but now I've got to collect some premium. I've got to also improve my probability of success. EM is trading for 44.31. I'm going to look at in March selling and this is going to be to see if there's enough premium there. Okay, I'm looking at selling the 45 calls and buying the 46 calls.
So I'm going to right click on the 45 calls, go up to sell and over to vertical.
Yes.
And then change it from 45.5 to 46.
Now this is a 1 point wide vertical and it's marginal at best. Okay, collecting about 1/3 the width of the strikes. That's all it is. But I need the out of the money premium and I need the 66% probability of success
for your overall
my overall thing.
Portfolio.
So I'm selling. In this case, I'm going to be selling 2 of the 44, 46 call spreads.
45, 46.
I'm sorry, 45, 46 call spreads for and we'll enter this, Tony, at 34 cents,
Okay.
which is the mid price, and we'll do it 2 times.
The stock is down 20 cents.
I know, but I can't worry about that right now. I mean, we'll deal with that later.
Gotcha.
But that takes me to my 66% probability of success. Okay, and I need to do that.
Correct on that trade. But when you combine the two, your probability of success is less in the overall portfolio because you had 50-50 on the first
No,
one.
I understand that, which is why I got to get it up to the right number.
I got you.
Okay, now this is the process.
I'm shaking it, boss. I got you.
This is the process. I'm going to run out of time. This is the process that I'm going to take. These are just the first 2 trades. I'm going to put both of these trades on today. These are going to be my first 2 TastyBite trades in my $5,000 account. And there's a couple takeaways from this. Number one is I want to show you that I don't have to only use, $10 or $15 stocks.
Correct.
Okay. Number two, I want to show you that I'm now looking at this after the first 2 trades, and I'm saying 50 on one hand, 66 on the other hand, and I'm doing two lots. My buying power reduction is in one hand is about $130, the other hand is about $100. So I'm keeping plenty of capital in reserve right now. Okay. And my overall probability of success about 58%. I'm just averaging the 2.
Got it.
All right. So I know now that I have to bump this up about another 8% if it's possible to do. Maybe I only get to 64, 65. And I know I've created a minuscule amount of decay and a minuscule amount of delta risk at this point. So now I'm already thinking in my head, because both of these trades are short, that my next trade in TastyBites is going to be collect a little bit more short premium and have a little bit more delta neutral.
Very good, sir.
Okay, so what makes sense there? My next trade will probably be some form of a calendar spread or some form of a diagonal spread where there's more potential decay in the front month and where there's the ability to take advantage of a higher probability of success. So I may make it into a kind of I may diagonalize a little bit. And my focus, again, to be very neutral on the next one so I don't pump up my deltas. All I'm doing is starting to build a portfolio with a really small account. Same type of strategies, same stuff.
I love it. It's a very good exercise.
It's a lot to push into 15-minute segment.
Yes, it is. That's the way we like to do it, though.
S&P's down 3 1/4 and bonds are down 18. That's the way we like it, Tony. That's the way we like it.
Correct.
Okay.
Now, if you get the euro to roll over a little bit, that'd be perfect.
It's funny, but the euro, well, I won't talk about it. It's only down a couple ticks. Forget it.
Yeah, they're pretty well done right there. So we got the second one. They call it TastyBites again, but I think these 3 videos, they actually go through that, that small account mindset where they're going through that, looking at their trades. So we'll see what they do here.
Thomas, we're back, my friend. TastyBites, where we talk about trading in a smaller account. So if you have a smaller account or you're thinking about opening one for somebody else, listen up. This is for you. Yeah, right over there?
What the hell is that?
I'm saving you some time so they don't put the camera on you where you're shuffling papers back and forth showing the back of your head.
I'm all good. Ready to go.
Here's what I'm trying to do. I try to throw you softballs all day, make you look good, set you up, give you some time, support you. That's what I do in here. What would you like me to do?
You're the best, Cherry. Where'd you get that speech from? I think I haven't heard that one before. I think it's recorded somewhere. It's 8:05 in the morning, and
Did you get your furniture moved for you all right last night with my guys?
Did a good job.
They did a good job, didn't they?
Did a good
Price
job.
was right too, huh?
What?
Because you picked the Ravens.
Yeah. Yeah, bet double
Pushed
nothing.
you into that whole thing.
Bet double nothing with the furniture guy and got
Free delivery.
Got free delivery last night.
It's like Amazon.
It was beautiful. 4 guys moving stuff.
No, a little bit more to the left. No, a little more to the right.
Beautiful
Guys,
job.
want a glass of water? See you later.
Beautiful job. 8:05. It's February 6th. I'm Thomas Osnoff. He's Tony Batista. This is Get Trading. This is the TastyTrade Network, and this is first segment of the day called TastyBites. Today, we focus on, and we do a bunch of different segments now. One of the things we did was we eliminated the guests on TastyTrade, we have some guests still, but for the most part, I eliminated all the so-called industry experts. I didn't do it. They're all my friends. I like them, but I felt that TastyTrade is much more valuable if our message is focused and it's direct and there's no conflicts of interest. There's no conflicts with respect to the message. And you know what? I'm also, to a certain extent,
Protective of our own content and our own customers.
Exactly. It's difficult for us to validate other people's stuff. I just don't know enough about it. I'm not comfortable with that validation process. So TastyBites is a little segment that we do in addition to, we do an IRA strategy, we do TastyBites, we do a scaling piece, we do best practices, we do confirm and send every day, we do market measures. There's a hell of a lot of stuff in there. It takes a long time to write this stuff up. Let's go to the first piece here. I'm going to focus today on something a little different before we get into some of the trades. Number one, I thought it's really important to have a brief discussion on expectations. Here's my problem with individual investing. And again, a lot of this is repetitive, but I don't think you can get enough of it. The individual investors have failed over the course of the last 50 or 60 years, and the primary reason for failure has not changed since 1920. So for 90 years, okay, we continue to fail, and the primary driver of failure is that we set unreasonable expectations, and so we don't take the time necessary to learn the domain. We would never do this in anything else because you'd be fired from your job, you'd lose whatever it is. But for some reason, with respect to investing, we decide we don't need to learn the domain because we can't meet our expectations anyway. And the reason you can't meet our expectations is because they're not reasonable. So I decided to do something, especially with smaller accounts, to set reasonable expectations. Because if you're starting small, okay, that's the killer right off the bat. If you're starting with a lot, you're starting with $2 million, you decide you want to lose $1 million, you still have $1 million. But if you're starting with $5,000 and that's all you have, if you lose it, you have nothing.
Correct.
Okay, let's go to the next one. So setting reasonable expectations for smaller accounts is extremely difficult, okay? Because people think at some point it's not worth it. So there's a whole segment on expectations, and I'll do a trade. So number one, transactional costs play a higher percentage role when we're talking about smaller accounts. So when you're setting...
Yeah, so that makes me think I tried on my 0 days to expiration Iron Condor. I ran out of my 3-day trades in a 5-day rolling period, and I tried the even S&P 500. I did the Iron Condor, and I looked at my transaction costs, and it was almost like $18. I mean, it was absolutely crazy. So I definitely decided, even through testing it out, I'm just going to stick with SPY and go from there and just do the 3 trades a week. Or maybe just wait until I get past PTT to do a 0 days to expiration strategy. But it's very small scale, and I'm up $5 if you don't count commissions. Again, just doing really small proof of concept kind of thing. Yeah, right. Do some GameStop and YOLO your money. Yeah. I mean, some people, I guess you do it at the right time. You might get lucky, but that's just the whole point, right? Like, it's a journey. It's not a, you're not just trying to hit a home run and win the lottery. And then, what's the rest of the story, right? It's like, I'm like a Lord of the Rings fan. So, it's almost like the argument where they ask, well, why didn't Gandalf just have the Eagles take everybody to Mordor and drop the key or drop the ring off? It's about that journey, right? Going through the different, going through that journey, just like Frodo in the Lord of the Rings. That's kind of how I feel sometimes when it comes to trading. So it's definitely the journey that I'm going after. I'm not trying to win the lottery here.
When you set reasonable expectations,
it'd be fun,
you have to understand the transactional piece to that. And you also have, of course, you have to take things into account, but you also have to understand that's one of the things that makes it more difficult. That's a bigger hurdle to overcome, all right? Because the transactional piece of the business is not linear. If you have more money, you get lower rates. If you trade more, you have lower rates. It's harder to do that with smaller accounts. So then you have, there's issues, of course. Mm-hmm. But so you set reasonable expectations. Why is it difficult? If you understand why it's difficult, you can do what it takes to get to the next level. So transactional costs play a higher role as a percentage. Number two, it's very difficult to conceptualize capital diversification. So what that means is, and I just experienced this with Case, there's as much as she wants to learn the business, okay, as much as she really wants to put on multiple trades, she cannot conceptualize at this point what capital diversification means. She's like, why do I need to have on 5 different trades? I don't even know what I'm doing with the first trade. Why do I need 5 trades I don't know what I'm doing with?
Well, I don't fully understand it, yes. She's got a good idea. She knows the direction.
No, of course, she knows. This is something I have to learn. But if I don't understand it...
Well, she only had 1 day with me when you were on vacation.
If this is something I have to learn, and I don't get it, why would I do 5 things that I don't get rather than just 1 thing that I don't get?
And I could focus on that one and just concentrate and micromanage it.
I hated paper trading.
Mm-hmm.
I built a paper trading platform because we got thousands and tens of thousands of requests, and because I thought to a certain extent maybe there's something there that you can practice with the technology or whatever else it is. Mm-hmm. But just the idea of not being able to put real money to use and being able to understand what capital diversification is, everything else, it's just so detrimental to long-term success that I always thought that these firms that sold investor education that put you on virtual platforms didn't make any sense to me. It drove me crazy because it never got you closer to the goal. Number 3. It is difficult to convert dollars into returns because the numbers are small. So what happens is you have this high transactional cost. You have a difficulty conceptualizing capital diversification. And then the next piece, which is even harder, is to convert dollars into returns because in your head, it doesn't make any sense. I had this, again, I'm going to use my daughter here because it's the fairest thing for me to do is rather than another customer.
Sure.
When we were driving home the other day, and I told the story live and on the show, we're driving home the other day, and she said, Dad, what am I going to do? You got me in 2 trades. The most I can make is $50, $34 on one trade and $16 on the other trade. That's $50. Okay. I know I'm only using $400 of my capital, but that's only $50. What am I going to do with $50? And I said, well, if you multiply 50 times 12, all right, that's $600 a year. And if you take $100 off that, just say $500 a year, that's 20% return on capital. And that's only using 20% of your capital. So if you can make a 20% return on capital using 20% of your capital, then what's so bad about that? Okay. And then she's like, well, and then I'm like, is 20% return good? She's like, well, right now I make nothing. So yeah, it's got to be good. My point is, it's very difficult to convert dollars made on a small account into return because the number's small. So Tony, like you'll be like, you go to Vegas with $100, right? You go to Vegas, well, let's change this. You go to Vegas with $10,000.
Okay.
You make 10%.
Okay.
You have a $10,000 line of credit.
Mm-hmm.
You make 10%, you make $1,000. You go home, you're like, I made $1,000. Not bad.
Correct.
Okay. You go to Vegas with $100.
Did I have any extracurricular activity going on?
No, this time you were good.
Just working the tables?
No, this time you were clean as could be. You never even left the casino.
Okay.
Okay. Maybe you got
I don't know
a
if I paid for the trip or this is just my winnings. Is this the stuff I got to throw on the table when I get home? I'm just trying to figure it out.
You went with $10,000. You made you went with $10,000 line of credit. Mm-hmm. You made $1,000. You make 10% of your money. You're pretty happy.
I got no other credits someplace else, any other hotels. Because usually I have one.
Nothing.
No. Good.
Next person goes with $100. Mm-hmm. Okay. They make $10.
Same percentage.
Same percentage.
Mm-hmm.
They go out. They buy a Starbucks. When he's gone, they come home. How'd you do? Oh, it broke even.
Correct.
It's very difficult to convert. You don't say I made 10%.
Correct.
Okay. Go with $100,000. You make 10 grand. I made 10 grand.
Right.
10%. Good.
Sure.
All I'm saying is, so it's a linear issue. Mm-hmm. So it's difficult to convert dollars into returns because the numbers are small. It's the same thing with my daughter. Number 4. Is there a number 4? Perfect.
Yes.
It's difficult to justify the effort because the challenge seems so steep. And I'm not going to get all psychological here and all that kind of stuff. But with $2,500 or $5,000 or $10,000 or $7,500, the amount of domain training required is no different than the person that has $10 million.
Correct.
Okay, so the whole problem with small accounts
will trade differently, but yes.
Well, of course, but the learning process for $2,500 or $250,000 is the same. So what happens is in your head, it's difficult to justify the effort because the challenge to get from listen, on $250,000, you have expectations that you can create a business from this. You have expectations that you can make enough money, blah, blah, blah. With $2,500, it's not the same thing. You're not going to be able to make, 300% on your capital.
Correct.
So it's difficult to justify the effort, again, because the challenge is so difficult, or the challenge seems so steep. And number 5, it's difficult to keep positions small enough. And this was going to be, I was going to star this one because trying to keep positions that are very small, Tony, is hard. You know that because eventually you get frustrated.
You get frustrated because the numbers are so small. You're looking at $2, $3, $7, $8 one way or the other. You talk about commissions and everything.
Okay, I'm going to go back to my daughter for one more second. So the first trade, she's nervous about pushing the button on a 1 lot. Second trade, she does a 1 lot. The third trade, she does a 1 lot. She's only 4 trades in now. They're all 1 lots, right? She's got 4 1 lots on. She's used a total of $600 in capital. You know what she said to me yesterday?
I was here.
When am I going to ramp this thing up?
Why shouldn't I be doing 5? Well, listen,
shouldn't I do a 5 lot?
This is up $18. Shouldn't I have done 5 then?
Right. Shouldn't I be doing 5 lots? If we're making money, shouldn't I be doing 5 lots? And I'm like, oh, here we go. Okay, I've seen this. So it is so difficult to keep your position small enough. So let me go over these just one more time because I love this segment, and I promise I will not let anybody down. I do the best I can with these small accounts because I've been dealing with it for a long time. Transactional costs play a higher role. This is why I call this expectations and set.
Yeah, it's like whenever I was doing strangles on futures, I was doing the copper futures, and it's like, man, if you want to blow up your account, shorting options, do strangles on copper futures when the implied volatility is high. And I guess that future is always high implied volatility. I'm not sure, but have a small account and give that a try. You'll definitely have some fun with that in your account. Don't do that. But that just looking from experience, that was a big reality check that told me that, hey, I really do need to, for one, I need to wise up and to trade small, to really figure out what that trading small, trading often is about. And I think TastyBites is going to deliver that pretty
reasonable
easily.
Expectations for smaller accounts is very difficult. Transaction costs are high. It's difficult to conceptualize capital diversification. It's difficult to convert dollars into returns because the numbers are small. It's difficult to justify the effort because the challenge seems so steep, and it's difficult to keep the position small enough. I promise you those are all real challenges. Let's go to the next. There's another slide. Achieving the objective. Okay, so here's where I put down just some of the things you have to do, Tony, in order to get next level. Mm-hmm. Number 1, you must commit to multiple positions. Okay, and that doesn't multiple underlines, multiple positions. You have to make that commitment. That's what I'm trying to do with Case. You have to commit to multiple positions because committing to one position it has the potential just to blow up. And I will tell you right now that 99% of the small accounts I saw when we were building and running TastyTrade, running Thinkorswim, was they were committed to one or two positions. Hence, they were not successful. The commitment to multiple positions is absolutely critical to success. If not, it's just you're one and done. It's all lucky.
It's 50-50 shot.
Okay, number two. And this is why also not committing to multiple positions is why 99% of futures traders and 99% of Forex traders go out of business. Because it's not about trying to figure out how to buy or sell something nonstop. That's part of the game. Correct. We do it all the time. But the game's much bigger than that. Number two, it's about not over trading, but managing to manage winners. Okay, so in other words, committing to multiple positions is critical, but not over trading.
Getting the mechanics down.
Because you have to get in your head. Okay, you're right. It's a lot. You'll see it in a second. But not over trading, but you're managing what you're doing in an effort to manage winners. 99% of the people, again, would be getting involved not to manage losses. In other words, to manage risk. It's nothing. It has zero to do with managing risk. It's again, there's a thin line between not over trading, but managing to manage winners. Okay, number three. It's learning to explain and articulate what you are doing. Now you're thinking, okay, I don't get that at all. And I would have never wrote this, and I've never seen anybody write this, but I would have never put this down on paper for years past. This is something I learned. Being able to explain what we're doing and being able to articulate what we are doing will help you now in a way I didn't even know that was possible. So when I'm thinking about this, achieving the objective, being able, and you're going to see some of the things that we're building right now at TastyTrade that will allow you to explain and articulate, because now we're starting to recognize what a valuable asset that really is and what an important contribution that is to success. So we're actually building technology now that will allow our listeners to participate in that mode, because we can see what we can take away from that. So again, achieving the objective. Linda, is that the last one? Okay. So with respect to achieving the objective, number one, you have to commit to multiple positions. Number two, you have to learn how not to overtrade, but you are managing what you're doing activity-wise in an effort to manage winners. You'll never once see me talk about managing losers or defining risk management. Number three, learning to explain.
Could you do that on order entry?
That's right. Learning to explain and articulate what you're doing to somebody else, because that will give you the kind of the internal validation. Okay, in order to
it puts the logic through your head. It makes you work you through it.
You keep repeating. Remember how they say when you're studying something to keep repeating something?
Or write it down. Right.
That's right. It is. Now, I had another slide which was going to be
trade examples.
A trade example.
So talking about repetition, I feel like I'm going through this series, just listening as I go, not taking notes or anything, just as I get time, kind of like a podcast or whatever, listening to the different things they talk about, and then going through here, taking the notes, going through it slowly, going through it, and then also playing it out after I have these notes, finding the watch list, the stocks, getting all those things together, being aware of the market, getting that watch list together, and then following through these objectives. I feel more comfortable, working out these things, So he's definitely right about that. Going through that repetition of learning, going through these videos, taking notes, and actually following through with these, laying out these objectives. And I'm kind of visual here on this, putting a picture there for objectives and getting a list together or whatever, and try to follow through on that. That's I think makes a big difference in your learning and retention. So I think he's got a good point there.
But I don't really have enough time to.
You don't, because we got about 10 minutes before the market opens.
I don't have enough time. That took longer than I thought. So what we'll do is next week, I will promise I will give more trade examples. I was going to do debit spreads today. I do not have time. Debit spreads for small accounts. I will try next week to squeeze in debit spreads and credit spreads, but those are information I want to get out there. It will all be archived. And I think it's really valuable to have that discussion today.
Correct, sir.
Good stuff.
Take a quick break.
Hopefully we get longer than quick.
Yeah, like DT Options is saying, yeah, I kind of learned that one the hard way. It was really big. When you're doing strangles, and a newbie like me, just been doing options for it's crazy. It's almost been a year, but just doing the wheel strategy and stuff like that. But I don't see, I saw the maximum loss is infinity, So that's not a big deal. And then your buying power reduction, it says a few $1,000s or whatever, $4,000 or $5,000. And it's easy to not pay attention to how much you're actually putting on the line when your loss is infinite, doing, undefined risk straight trades. So it's really anybody watching this, that's new, to try to stick with defined risk trades, doing spreads and things like that, like they talk about here on Tasty Bites, because it'll save you a lot of trouble defining that risk. All right, we'll get through this third video. I think we can probably do it. We might run over just a little bit over an hour, but I think it's worth
if you
doing
knew to
it.
get tasted, that last segment that you watched there was when I win Employee of the Month award for.
Do you?
Do you? What, is somebody going to chop off a finger and come back to work and stay here?
That was impressive. I just can't.
You hide your face like a little.
I can't.
Girly man.
I just don't want. I didn't want to be. Whatever.
What? You didn't want it to be what?
What?
I was the one over here dying.
I just didn't want you.
And you kept talking about tzatziki sauce. I mean, you kept poke the bear.
What's wrong with a little tzatziki sauce?
Tell you don't feel good. I ate bad Greek food. I think I got food poisoning. Tzatziki sauce. Oh, yeah.
I love a little yogurt and cucumber sauce. Love a little tzatziki.
God, I just looked at it, watched it, man.
You were white.
Sick.
Yeah, you were like ghost-like. Yeah, that was nasty. Then you went back there, got all those guys sick.
No, Alex took a couple of days, played hooky.
Oh, yeah.
Slim took off 2 days. Nothing takes you down though.
I'm sure you were.
And your other evil twin over there that you're making, she was good to go. No problem there.
All right, you ready?
Yep.
Got my little Tasty Bites. Linder.
Did I say that today? Is that why you're doing that?
Linder?
You're just tired. Yeah.
No, you say Linder a lot. So what I did here was I put this into a little bit different format today, and we can talk about the trade examples in a couple seconds. But what I wanted to do was just kind of walk you through. I think it's like 5. Let me check.
I got people writing in 40,000 people a day at Disney is easy. I'm writing back. Tom said no.
I'm just thinking it's a lot of people. 360 days a year.
Tom said no.
Okay, I'm just thinking it's a lot of people, but maybe it is. Maybe I'm totally wrong. It's a big percent of the population goes to Disney. Can't believe I've never been to a single Disney park. Wow, I think that's cool. All right, low volatility environment. That's what we're in right now. So we talk a lot about directional plays. I thought it's time. Tasty Bite segments designed for smaller accounts. A lot of people have accounts that are, let's say, 2,500 to 5,000 to 10,000. Anything less than 25,000, we consider it to be kind of in that Tasty Bites family because you're limited by what the industry calls pattern day trading rules. Pattern day trading rules just were put into effect to protect you from yourself. Stuff that drives me, wants me just to drive off a cliff type stuff because it's so ridiculous. It's a disincentive to be successful. But until we figure that out from the regulatory side, we have to deal with what the rules are. So part of the discussion I wanted to have today was about what do you do in markets like we're experiencing today? Hey, we're in a very dull, slow, low vol environment. And this is the one time when you have to kind of, there are no volatility plays. I mean, there are every once in a while you can fall into an earnings play, but those are tough because there's not even any edge in the earnings plays. You can also maybe you can fall into some other kind of an opportunity like a
BlackBerry,
right? Like a BlackBerry situation, something like that. But even so, okay, those are few and far between. There's lots of dollars chasing that stuff. So what I want to talk about was in low vol environments with small accounts. Let's talk about some of the logic behind directional plays. I have 4 items here, and each one has a A and a B. For starters, let's talk about just taking what the market gives you rather than trying to force something. One of the things we do, and I see it with my own daughter. Every day we talk about the markets a little bit before we come on the air, and we talk about things, and she's always like, well, why don't I do this? Well, this guy said to do this. Hey, Tom, hey, Dad, or whatever she calls me. This customer sent me an email and said I should be doing this. And I think he's right. Okay. Or downstairs, she'll listen to Jeff and she'll go, Jeff said I should be doing this. Okay. And it's working for him. I'm like, listen, I got it. Okay. Jeff said this customer said this other person wrote you this. I understand it. But you know what? This is not a time for these generalizations. This is a time for taking what the market gives us. A lot of times what we do as investors is we think we always have to do the same thing. There's a certain mechanical consistency. There's also a mathematical piece to everything we do. But the flip side of it is, if it's not there, you can't do it. The analogy I used to use was the baseball player who hits a lot of home runs. Let's use an Adam Dunn on the White Sox or a Dave Kingman going years back. They hit a lot of home runs, but they don't hit for average. And that's because they don't take what they don't take what the pitcher gives them. They take what they're looking for, and therefore they're not successful average-wise. I think in order to be a successful investor, you have to take what the market gives you. In order to be a successful trader, you have to take what the market gives you. We talked a lot about this to all the traders over the years that we backed. You know what? Don't force it. Wait for the marketplace to come to you. So then, that's number one. A, contrarian verticals, mostly debit spreads. That's taking what the market is giving you right now. In other words, if you're up 30, how many days? How many days so far in 2013? What? 30 trading days.
How many trading days have we traded?
Yeah, 30. About 30 trading days.
About 30, sure.
Right around, let's say around 30 trading days so far in the month of January and half of February. All right. Of the 30 trading days, I don't think we've had more than a handful of down days. Okay, we're probably running about 80% up days, right?
Yeah.
Pretty close to that. Let's give or take a little, whatever, who cares? But we're running really close to about 80% up days. So the contrarian play here, this is what the market's giving you. Okay, it's not a question of, hey, I'm bearish or whatever. The market's telling you right now, based on where implied volatility is as a percentile of where it normally trades, as a percentage of what historical norms are, it's suggesting to you that a contrarian approach, okay, just based on some return to normalcy somewhere down the line or some normalization down the line, a contrarian vertical, as I call it, is just a way for small accounts to play the other side. Okay, that's just if we know, there's a couple things we know about the business. One of the things we know is that the professional and the exchanges pay for order flow. Now just think about this for a second. So if Tony's a professional trader, he'll give me $1, okay, for sending him an order.
As a brokerage firm.
I'm not giving up any edge to him. So why are you giving me $1?
There has to be a perceived value over $1 in that trade.
I understand. Not in that trade. You have to give me $1 for every trade I make.
Trade, right.
Okay. So you give me $1 for every single trade I make, and you don't. But I don't think I'm giving up you any edge because I think I'm smarter than you are. So you're paying me $1 because everybody else out there isn't that good. But at the end of the year, you make money and everybody else loses. So the $1 is a smart investment.
Sure.
Okay. That means, and all you're doing is the opposite of what I'm doing, which means the contrarian model works, period. That's it, period. Mostly debit spreads, Tony, because in this particular market, it's the only spread that kind of gives you that 1-for-1 with defined risk and no negative carrying costs. Okay, it's not a big short premium play, it's not a long premium play, but you're not really buying any extrinsic and you're doing the most conservative way in a small account to play that contrarian model. A trade example is buying an at-the-money call spread.
So I'll go ahead and do an example here. I've got SPX pulled up, and so we've got a put spread here. Just I guess it's $10 wide here, but one strike wide, and there's a button down here on the order entry, and you can do a swap, so you can actually turn it into a debit. And like whenever he says trading the other position, you can see that or the other side. The pop down up here is 38%, and if you hit swap, the other side of the trade is 62% pop, and it's the same with max profit and max loss. So it's trading the other side of the trade or of the position there.
Apple. The other day, just to throw out an example, the other day we kind of got to the point where Apple was very oversold. We were talking about it on the show. We talked about it probably for 2 or 3 or 4 days straight. Hey, you know what? Apple's getting down to a level where it's very oversold, blah, blah, blah. Even in a small account, you can trade a $600 stock, $500 stock, $400 stock. This time was about $440. And an at-the-money call spread was trading for about $250. Okay, and that's an example of a contrarian play inside of a very strong market. Okay, for a small amount of money to play, which would be a contrarian vertical, mostly a debit spread. Let's go next one.
It's a stock substitute, right? I mean, that's really what you're doing there.
Correct. 2, resetting expectations. Reasonable is the key word. So, Tony, you're a small trader. You have a small account. You're a small trader. And one of the mistakes we make is we have expectations that are ridiculous. I'm going to go back to my daughter because it's fun. I can talk about her. Or maybe I can't. But
you can, whether she'll talk back at you or listen to you.
I'll find out later.
Right.
But so Kay said to me yesterday, she goes, hey, Dad, quick question about this. You're setting me up here to make $25, $14, lose $100, make $50, whatever it is. All of a sudden a week ago that was a lot of money to her, and now that she has positions on, she's like $11 a day, up or down. I can't live. I got this guy sitting over here to my left. He's making $1,000. I got this kid doing whatever. And I'm like, just reset your expectations, make them reasonable expectations. You are not in a position where this is going to be a game changer for you in the sense that this is something that is this is going to be a game changer with respect to the rest of your life. You are going to be self-sufficient. You're going to be able to manage your own money. You're going to know more about the markets and investments and money management and portfolio management and building wealth than anybody that you probably ever meet. But you're not going to turn $2,500 into $10,000. Okay.
This month,
next month, this year, next year.
Right.
Okay. So get that out of your head. Reset expectations. Make them reasonable. The reason we are not successful as a consumer, as a self-directed investor, as a consumer, is because we have unreasonable expectations of return. Period. Okay, you have a $2,500 account, you still think you're going to make $10,000. Just like you go to Vegas with $2,500, you think you're going to make $10,000. Neither one works. Okay, if you set a reasonable expectation, my goal this year is to make $500. It's very doable.
Right.
Maybe even $1,000, a 40% return. That's very doable for some people. But to make some multiple, that's not. So especially in low vol environments now, when there's no edge, reset your expectations, make them reasonable. A 13% VIX means less than a 1% stock move daily. That's how you reset your expectations. Again, and especially in small accounts, because people go like, somebody sent me an email, they go, well, you're trading this stock. I think it was TZA or something. Okay, and it was like $11 stock or something.
Yeah, I just thought of something, and we're getting close to time, but we'll finish the video. Resetting your expectations, like having that reminder. I don't know if you could have that on repeat or something, but having that expectation reset. You're either going to have those expectations, whether they're wrong or right, you're going to reset that expectation whenever you lose your money. And if you're putting too much up front, that expectation is going to change either in the form of your P&L or it's your mindset. So just a huge reality check there, like a daily reminder that I have a small account. I'm not going to make a lot of money here. It is a learning journey, and we need to keep our focus on the long term, not the short term here. We're not trying to hit a home run again. Over and over, playing it in your head, long-term outlook, and learning as you go along. That's why I named my channel Learn As You Grow, because that's what my plan is to always just try to keep that mindset of keep going along, have the right long-term mindset, having those right expectations. Oops. I should probably just let it keep playing.
And it also assumes that 1% move. So there'll be opportunities to take profits. It's all part of that learning process. All right, let's go to the next one. So number 3, don't forget the opposition. Perfect pricing and 0 risk-free returns. Okay, so in other words, the opposition here is what am I up against? What am I up against every single day to make this stuff work? And what you're up against right now is a lot of dollars chasing very small returns. On your cash returns right now, Tony, you get 1/10 of 1%. If you get 1/10 of 1% on a cash return, that means there's a lot of money on the sidelines, and that money is chasing perfect pricing. And a lot of people want to make money from your money. So you have to deal with, figuring out what's bull and what's real, and then understanding that whatever's real out there, it's real to both sides and it's priced perfectly because you're up against risk-free returns of 0. Okay, so it's very difficult because of that. It's very difficult to make money. So understand you're not alone with excess capital, because what most people think is, oh, I got some money, I'm rolling. Okay, I got some money, but you're not. Everybody's got money now. When I say everybody's got money, it doesn't mean everybody's rich or any of that kind of stuff. What it means is there's a ton of capital on the sidelines because bonds are 0 and stocks are at all-time highs. So just remember, there's lots of money chasing returns. And so if you see something out there and says, well, I just sell these, I'll make this, it's not that easy because everything's priced to perfection.
Right. It's also when we're talking about timing the market a little bit, and if you can't get to the last slide, maybe we can save it for the next time. But when we're chasing the market, when you have a market like you've had today, by the way, you were a little off on your statistics. If we had about 30 days, there's only been 7 up days. That's about 77%. I think you said 80% off the top of your
7
head.
down days.
Yeah, 7 down days, right. When we're chasing the market like this, the first down move is met by buying by those that are sitting on the sidelines waiting to buy it on the cheap, so to speak. And that's why we always talk about, let's see how it behaves on the first down move to market.
So again, one of the ways to do this in a small account, okay, a trade example would be buying an in-the-money put spread in like the financials, using something like an XLF or using something like one of the inverse ETFs, for example, like FAZ or FAS, depending on which way. But what you're seeing here is a certain level of consistency with respect to contrarian theory. So I'm doing contrarian-driven verticals that are debit spreads, and I'm doing at the money or in the money, and trying to just show you how many different ways you can diversify. Again, with all the logic that supports kind of that debit spread, that directional vertical argument. Okay, and then number 4, I got to go through this quickly.
Sure.
Sorry, I went a little over. Understand that markets move, and seizing opportunity is the key. So what I want to say here was you can't chase positions with small accounts. You have no room to be wrong. We talked about like Buffett and people like that. And to a certain extent, I'm very similar in that I will hold positions much longer than most people. If I still have the conviction and believe in my assumption. The problem with small accounts is you don't have that luxury. And it is very difficult. You can't outlast the markets. Right? There are certain players out there. There are certain people that have either enough capital or enough staying power for whatever the reason is that they can wait things out. I don't think that small accounts have that option, have that luxury. So you cannot chase positions just for the sake of getting something on. You've got to let the marketplace come to you, and you have no room. You have room to be wrong. You have no room to be stupid, is what I should have written on here. You have no room to force anything because you can't do
Forcing
something.
is better than
Yeah. You just can't do things that put you in a position to lose because you're going to lose anyway because people lose. Okay, some people win, some people lose, and all traders lose. Not in the end. I'm saying all traders make losing trades. All traders make losing trades. So at some point, okay, you're going to make losing trades. You just can't make really bad trades here. So you just don't have the room to make bad trades. An example is buying an at the money.
And a bad trade would be doing all of those things you just talked about, right? Setting unreasonable expectations.
Chasing a position with small accounts. Just a lot of people chase.
Gotcha.
An example here would be buying an at the money call spread on an inverse ETF. Okay, because that's a situation where, as a small account, you can find something that you like. You can buy something that's at the money. You can kind of run with that.
Sure.
Right? And okay, that's it. Just to give you, I'm trying to bring some consistency to the small accounts.
I like it.
Okay.
Works out good, sir.
Went a little bit over, but Linda, we'll take a short break. We'll come on back and we'll archive all this stuff. We'll come on back and we will.
Get opening bell, Thomas.
Yes.
Be back in 90 seconds just to get tasted on the TastyTrade Network.
All right, so we made it through the 3 videos. We've hit our hour. Just to kind of give a quick recap on what we've kind of learned or gone over. Pretty much covered again what the plan is with their small account. They don't end up doing that throughout the series, but it gives us a little insight on how they would handle a small account, with $5,000. And then we have the setting reasonable expectations, which we went over, realizing that you're not going to make a lot of money in a small account, but you are going to be learning through that small account. And so that's the key there, is to continue learning and having those strategies, trading the stocks, looking for the opportunities that the market presents. I think, so we're kind of getting into, as far as like achieving the objective, I think that's something to kind of focus on next week here when the market opens Monday. Committing to multiple positions, right? I'm doing 12 a week. That's my target. Not over trading, just trading for the sake of trading. I mean, if it's less than 12, that's fine. But that's kind of my target. And then looking at managing winners there, which my targets are 50% on the credit spreads, and then the iron condors. And then my 0 days to expiration are more around like 20%. Being able to learn and explain and articulate what it is that you're doing, right? Whatever the strategy is. So they touch up on low volatility directional plays, and I think they're doing that because whenever they're coming out with the TastyBites here, I think it was a low vol market, and so they try to do some debit spreads there. I've never done a debit spread, but it might be something to kind of look into. It's not part of my strategies that I have picked out. But anyways, they talk about it there, give some trading examples. But the key to these 3 videos is resetting expectations with the small account, and then focusing on these objectives to achieve. So we'll be keeping that in mind Monday. I won't be doing a live stream tomorrow. Just keep an eye out whenever I have a schedule posted, and we'll go from there. And I'll try to get some kind of schedule going on with this, where we have a steady schedule on the series here as we go through it, and just so you know whenever I'm going to be live. So I just want to get this kicked off and get started on it. So that'll cover it for today in the R&D room. So we'll stay tuned for the next live stream. Thanks for tuning in. We'll see you again.